Welcome to our annual market outlook for 2021 titled Hope is Contagious. We have 4 discussion points for 2021. Let's begin with a very quick review of what happened in 2020. To put it simply, the year has been a series of unfortunate events. We began 2020 with Taal volcano's eruption, followed by the onset of COVID-19 in the region. By mid-year, the country being in lockdown has pushed us into recession, and in the past 4 weeks alone, we have been visited by 5 typhoons. 2020 definitely is a year to remember for stocks. In January, we were at the 7,800 level before plunging to a low of 4,039. But hope springs eternal, and as of end November, we were at 6,800. Taking a deeper look at the index, we have 8 gainers for the year led by Emperador and PLDT. On the losing end, we have Robinsons and Big Bank Security Bank, BDO and Metrobank. Note that 5 of 8 gainers starred in 2 Trade Asia's reports. Having been through most of 2020, we learned that, first, price action precedes actual recovery, and that we must position in anticipation, not in reaction. Second, multi-year support levels deserve attention and are often very good entry points for value investing. And third, dividend plays work and are good portfolio buffers, especially when times are volatile and uncertain. But 2020 is almost over and we move on. In our case, we are setting sights on a rally towards 9,000 by 2022. Here are our reasons why we make this case. First is because of the pace of vaccine development. Granted that we get successful local deployment by 2021, a reversion to pre-COVID scenario is very much likely by 2022. At the end of the day, the market crash of 2020 was due to COVID-19, and once science gets an answer to that, the market can better digest post-COVID fundamentals. The important thing to watch out for after distribution is the duration of the vaccine's immunity, which for now is unknown. After all, these vaccines aren't equal, and there's still so much we don't know about COVID-19. Second is that low interest rate environment, especially for short-term securities, make investing in equities much better in terms of returns. Even on a dividend-only strategy, ample access returns can be met. Simply put, it makes sense to own more stocks now than 2 to 3 years before. Third is that major resistance drivers of the past years are also now easing. For instance, President Biden winning gives more optimism for US-China trade war to at least be more diplomatic and less erratic. Another concern were delays in both tax reforms and infra projects, both of which are priorities of the Duterte administration. We are now seeing tangible progress given the passing of the CREATE bill recently. Finally, we expect a significant impetus on the domestic consumption side as we near a double election year in 2022. And finally, looking at earnings and recalibrating valuations, 9,000 by 2022 seems to make sense. It will put us at 20 times forward PE valuation, which is the median multiple during bull run years. To quantify our expectations, we move on to our next discussion point. Experience alone will tell us that recovery is evident. The question is, how strong do we expect recovery will be? Here we have 2 scenarios. The optimistic scenario is positive 6.9 GDP growth, assuming vaccine deployment by second quarter, more relaxed quarantine restrictions, second half's pre-election season, and the reduction of corporate income tax from 30% to 25%. On the more conservative side, we expect continued shrinking of the economy if vaccine deployment is deferred to 2022 on procurement and logistics issues, and if GCQ is maintained for the whole year. If everything goes well, we're priming ourselves for a stellar 2022 since 2021 will be coming off from a low base. 2022 would then mark a fresh start for the economy as we adjust to our new normal, with its own changes, as it will also be an election year. On inflation, we expect prices to remain benign, albeit slightly elevated next year, falling within 3 to 4% in line with Bangko Central's guidance. Impact from typhoons might keep agri-industrial prices elevated in the first quarter, but should normalize starting second quarter, assuming no major catastrophe creates significant damage to the economy. We expect earnings for 2020 to fall by 33% before recovering with 39% expansion in 2021. Note that low base effect will kick in during that year. By 2022, when everything is expected to stabilize, a more stable but nonetheless significant 22% earnings per share growth is expected. What does this all mean for our local bourse? Best case, we may see prices trading between 8,000 and 8,500, assuming smooth vaccine deployment by second half of the year. Also, create Bill's first impact and more relaxed restrictions. Should status quo prevail, we might remain within our comfort zone between 7,400 to 8,000. And should we regress with reimposition of stricter quarantine restrictions, delays in the vaccine distribution, or major catastrophes, we may see the PSEI test 6,700. Now we move on to the final part of this report, our sector and stock calls.
We are overweight on banking, consumer, renewables, and media, while putting property and telco on our watch list. And finally, we are neutral underweight on gaming, water, and downstream oil. As mentioned, here are our overweight sectors beginning with banking. We believe that 2021 will be a recovery year, with EPS growth expected to range between 16 to 61%. This will be partly driven by the return of loan demand, given the low interest rate environment. We also expect the ramp-up of projects next year to stimulate economic growth. Lower provisioning will also make year-on-year comparisons significantly better. There may be risk of further asset deterioration due to elevated NPLs, but looking at the coverage of banks, we are confident to say that they can absorb the risk after front-loading provisions this year. Capital buffers are also adequate to weather any potential losses. Banks continue to be good value plays after dropping significantly from their historical price-to-book averages. Our current discounts range from 22% to as high as 50%.
Our outlook on consumer is sunny, and that is premised on a simple observation, which is that mobility is very quickly recovering. Recent Google mobility reports show promising consumer movements in retail and recreation and grocery in particular. To support that, we did a simple, straightforward survey asking 100 random participants where they are most confident putting their money at for 2021. Not surprisingly, staples won, with groceries and healthcare scoring high. On the other end, travel and more discretionary activities scored very low, showing us that first, defensives will continue to benefit, and second, the pandemic is still affecting consumer behavior, at least for now.
Moving on to renewables. The growth potential for renewables increased after DOE issued a moratorium for greenfield coal plants. DOE will also be conducting a green energy auction of an initial estimate of 2,000 megawatts by next year, and the implementation of RPS, which requires distribution utilities to increase their RE requirements by 1% annually. This will eventually help in achieving DOE's 2030 target of 35% share of RE on generated capacity. The DOE also laid out its target new additions per technology until 2030, which gives investors a hint on what stocks to accumulate based on the company's exposures and future pipeline projects. AC Energy Philippines, FGen, and Meralco are among the big names. However, challenges will continue to weigh down growth potential for RE, which are mainly due to high upfront cost, potential issues on siting and transmission lines to the grid, as well as reliability, especially solar and wind.
We are also optimistic on media, being that 2021 is a campaign year. We have compiled the market size for TV advertisements, and there is a clear cyclical trend where ads peak during election years. To support that, the recent shakeup between the two major broadcasters has made the market less fragmented, and GMA7 has emerged as the clear leader, which has better space to corner ads and more leeway to push ad rates higher. For our wildcard picks, for property, we are closely looking at vertical provincial developers, which we think should benefit from relatively resilient property fundamentals, especially for the unhoused population. Weak BPO receipts will make commercial offices look at least flat in earnings per share terms, while limited foot traffic for malls and tourism plays are to be expected. Finally, for telco, the obvious factor here is Dito Telecom's market disruption. Up to what degree it will affect pricing and market share poses risk for the current incumbents during a time when the sector is clearly benefiting from higher internet usage. We are on a more cautious stance on the following sectors. First is gaming. It is premised on lower VIP gross gaming revenues outlook as flights have yet to fully recover. On the other side, mass GGR will also be stunted by wallet reallocation. Next is water. Water firms will continue to be challenged by regulatory issues on top of there being no major volume driver for next year. Finally, our outlook for downstream oil remains bleak, mostly because energy demand from vehicles remains subpar, and global oil price uncertainties will make inventory booking more or less bumpy.
Now we are going to share to you our stock picks for 2021. First, we like AGI. It has attractive valuations at 7 times 2021 EPS versus its 10 times historical average. Resiliency of its liquor business will also provide support for growth, plus expected strong recovery of its property business, which will offset slow recovery of hotel casino and QSR segments. Our target price is 12.86 pesos. Next will be BDO. BDO has the most stable NIM growth among banks, and we like BDO as well versus other big banks given its very attractive valuations of 1.16 times 2021 price to book versus its 2 times historical average. It has also boasts good balance of loan mix and superior network. We set our target price at 125.37 pesos. Next would be Metrobank. Metrobank is our other banking pick as it continues to trade at a very low level at just 0.57 times forward book value versus 1.1 historical average. Negatives seem to be priced in already, and we believe that with this sufficient capital buffer, which is at 19% CET1, and prudent provisioning, expected asset deterioration will be significantly lower year on year. We set our target price at 59.66 pesos.
Our stock picks for 2021 also include the following. We have Universal Robina, a giant in cyclicals. It should benefit from generally better consumer confidence, especially on its branded segments. Margins have also right-sized, which should fare well in the coming quarters when the extra demand from election front-loading kicks in. Our target is at 170. Next is Robinsons Retail. It is our top pick for retail as it is the most diversified name in the sector and we would like to capture the anticipated recovery there. Good news is that Rustans is also stabilizing, which should give RHI's valuations more upside. Our price target is at 79.25. Finally, GMA7 is an obvious pick. As mentioned previously, it has market capture advantage with an ability to tweak rate sheets favorably. It is also a perennially decent dividend play with yields on the 45% range. Our target is at 8.63 pesos.
2020 will be a memorable year of challenges worldwide. 2021 will be a strong restart process, and the Philippines will be among major head-turners. Borrowing a caption from Michelle Obama, don't underestimate the importance you can have because history has shown us that courage can be contagious and hope can take on a life of its own. Thank you and happy investing.